Okay, so thanks for including the paper in the program. I am also not from Copenhagen Business School, but I used to be there until very, very recently. So this is basically my, it's my fault. There is no mistake with other people. Okay, so so a basic premise in financial economics is that prices collect and contain very precise information from all kinds of market participants, and hence provide precise information about fundamentals, right? Itai's talk was about it, the previous presentation was about it. Realizing that prices should be very informative about fundamentals, it is very natural to think that decision makers on the real side of the economy will make use of this information as well. So what I'm doing in this paper is that realizing that there is some kind of a feedback from price informativeness to real decisions, what happens if we consider the effect of, let's say, trading constraints like short sale constraints, borrowing constraints, etc., on market participants. Now, naturally, these would change the the information content of prices. So if there is a feedback to real decision makers, then they would affect the information content of. So they would affect the real decisions as well, and apparently, it would affect real economic activity and efficiency there as well. So the research questions in this paper are the following. How do short sale constraints influence the information efficiency of market prices? I will have a very stylized model because it turns out that once one tries to incorporate all kinds of frictions into the trading part of the economy, then the usual techniques break down, normality doesn't hold anymore, so all these like learning from different signals and prices, etc., becomes complicated. So you should think about like cost of shorting or difficulty in shorting, like rebate rates, regulatory or legal restrictions, search frictions. Some assets are like harder to find for shorting, etc. But I will model it in a very stylized way. So this is what short sale constraints we refer to. The information efficiency, as we have learned from Itai's work, again, is like not straightforward. One could talk about like the ability of prices to aggregate and transmit information, but already there we will have kind of two levels. Forecasting price efficiency, that is, like if we want to forecast the fundamentals of the assets, how informative prices are. So let's say like the inverse of the variance of the payoff of the asset given the price versus revelatory price efficiency, that is the information that some decision makers can learn when they take their private signals and the price into account. Okay, so eventually what the paper will be about is to highlight that these two things, even in like the simplest models, don't go hand in hand, and there is going to be some really interesting implications of short sale constraints on the revelatory price efficiency part. And then basically I try to apply this observation in a model where prices would provide information, feedback for real economic activity, and I will be interested in the allocation of efficiency in the real economy. Again, the model is like really, really stylized, as you will see. So there are a lot of ways in which one can enrich the model, and like lots of things to demand eventually. So the prevalent view about short sale constraints can be perfectly illustrated by, for example, the SEC press release when they introduced short selling constraints in September 2008. So we know that short selling improves liquidity and price informativeness in normal times. However, it also reduces the ability of a firm to raise equity capital or to borrow money and makes it harder for banks to attract deposits. Now you can think about the second part whichever way you want, that they can lead to like some kind of runs, etc. In my model, what I will do is to forget about all these like runs that short sale constraints can eventually prevent. I will just really focus on like learning in like very simple, no strategic kind of settings. So what I will show you is that the informational effect of short sale constraints is, as I said, not straightforward. The change, first, they change the information content of security prices in the sense that prices contain less of the information of traders. So the FPE goes down, but they can provide more information to some agents who have additional private information. And through this second channel, they can have real economic implications, because if these agents are more willing to invest in good or profitable projects, then allocational efficiency in the economy can go up. So the paper's contribution is to theoretically analyze price informativeness under feedback and trading constraints and to provide eventually an informational argument in support of short sale constraints. So this is how the setup will look like. There is an asset market. An asset is traded. It has a random pay of D. You can think about it as a stock. There are three types of agents trading: informed, uninformed, and noise trading. This is like a standard Grossman-Stiglitz setting. Noise trading have a demand shock U. Informed agents, they all have the same signal S, which is informative about the payoff of the asset. And uninformed agents don't have any signal, but they realize that they are trading with informed agents, so they try to learn from prices. Okay, then in the end, when these agents trade, it's going to be a rational expectations equilibrium. So the price will reflect the signal of the informed agents and noise, and everybody taking this information content into account, they are choosing things rationally. So the market price aggregates, kind of collects the information and clears the market. Okay. So there is going to be a second part of the economy. There are a set of investors or creditors. They would have private signals as well. They don't participate in the asset market. Instead, they are making an investment decision, how much capital to provide to this firm. Or if you think about like short-term creditors, again, I'm going to be a bit stylized here, then whether you want to like roll over your short-term debt or not. Okay, and the firms or the financial institutions' fundamental is like correlated with the payoff of the asset that is traded in the market. Hence, investors or creditors will make use of this of the security price, and this will eventually behave as some kind of a public signal to these agents. So they have investors have a private signal, public signal. You combine these two to make your investment decision. And the question is, if I introduce short sale constraints in the security market, how does it change the belief of investors and how it changes their investment decision? Okay, so the way I will model short sale constraints is that a lambda proportion of informed agents cannot short. That's simply, so they cannot take negative positions. One could introduce short sale constraints on uninformed traders and noise traders as well. But if we introduce it on uninformed traders, it would only affect the level of the prices, not the information content of the prices. And if I introduce it on noise trading, then eventually the effect that I'm talking about is going to be even like amplified even more. So I will just stick to this simplest setting. And what I will not do, so eventually what will happen is that, as in the case without trading constraints, the price will provide some kind of a combination of the signal and the supply. So we will be interested in, or this demand shock from noise traders. So we will be interested in this information content of the price, the p hat. Short sale constraints will eventually lead to some really complicated prices, which in some cases I cannot even give in closed form. However, the information content of them is pretty simple, and that's what matters when one thinks about the belief of these investors and creditors. So what I will not do is to make the more natural kind of connection between the investment decision and the asset traded, namely that the outcome of this investment decision would affect the payoff of the asset. The reason for this is because things become like really, really complicated there. As I said, with these short sale constraints, all these learning things are a bit untractable. So I'm working on that at this point. I'm somehow not good at pushing this button. Yeah. Okay. So I will tell you first about the asset market and how introducing short sale constraints on semi-informed traders change the information content of the price. And then for this firm with multiple, like one or multiple investors or short-term creditors, they will have a public signal, their private signal. They learned from it. And the particular model or setting that I will focus on is that there are going to be a continuum of them. They will face strategic complementarities. I just want to introduce some kind of an inefficiency. Inefficiency will come from the fact that there is some coordination need. They face strategic complementarities. And I will hopefully show you that introducing short sale constraints in the security market can mitigate the inefficiency in this real side of the economy. So the asset market is the very standard Grossman-Stiglitz model. Informed, uninformed agents. The informed agents all get the same signal S. They are in some positive measure. Uninformed are 1 minus this omega measure. They observe the price only. And there is a demand by noise traders, U, which makes sure that prices do not fully reveal the information of informed traders. The important deviation from the Grossman-Stiglitz model is that a lambda proportion of informed traders are subject to short sale constraints, so they cannot take negative positions. Equilibrium concept is the same as always. OK. So to solve for equilibrium prices, normally the approach for these models is to do conjecture and verify, but this doesn't really work here because it's not obvious what kind of price function we should conjecture. So instead, I'm using this trick from another paper of mine, which has showed up in previous papers in the literature as well, that we know that informed traders' demand in this model is independent of the price function. They are not learning anything from prices, so their demand is the same as in the GS model, except some of them cannot take negative positions. So this would be either the same as the unconstrained agents demand, or it would be 0 if their signal is sufficiently low compared to the price. Let's plug this into the market clearing condition. So if we rearrange things so that everything that uninformed agents don't know, that is the signal and the noise trader demand on one side, and everything which only depends on the price and known parameters on the left-hand side, then we can basically back out what the information content of the price kind of can be at maximum. Right? And it turns out that because of this kink at a certain level of the signal of informed agents, which only depends on the price realization, the information content of the price becomes a piecewise linear function of the signal and the supply. Okay, in particular, for signals high enough, this information content is the same as in the case without short sale constraints. However, when the signal is lower and informed agents would like to short, some of them cannot. So eventually, a lower demand from informed traders is facing the same amount of noise trading. So the price will contain less information of the signal of informed agents. This coefficient is going to be lower. Okay, the price will be noisier, but it will have this asymmetric noisier. Yes. So the equilibrium price can be solved in closed form if we take the information content of the signal precision to 0. That is, agents would have an uninformative prior. And in this case, the price is indeed a linear combination of things. If that's not the case, then there is no closed form. We can only give it in an implicit equation. But importantly, the information content of the price is this piecewise linear combination of the signal and the supply. So in equilibrium, the price informativeness measured as what we learn about the payoff given the price decreases, because in some states of the world, the information of the informed traders does not get into prices. However, this decrease is asymmetric because prices that are higher than the fundamentals are more sensitive to the demand shock. Prices that are lower than the fundamentals are just as sensitive to the demand shock as before, because in those states, informed traders would be buying. In the other states, when the price is too high compared to my signal, I would like to short as an informed trader, but some of us cannot. So the model has a couple of predictions in line with what effect short sale constraints would have on prices, what effect short sale constraints would have on prices in line with some empirical observations. So what happens now if I combine this public signal with some additional private signals that certain agents would have? This asymmetric structure will be really important here. So basically what happens is that those agents who have signals, private signals relatively high to the, compared to the public signal, and those who have low private signals will learn in different ways. The reason for this is that now you have two pieces of information. Your private signal says that the payoff of the asset is high, okay? But you still want to combine it with the public signal, which is a combination of the signal of the informed traders and some noise. You realize that this public signal has this asymmetric nature. As long as the state of the world is really low, so the asset payoff is low, then informed traders in the market would like to short, but they cannot. So the noise trader demand is amplified to reach this level of the price. Okay? But those states, according to your private signal, have very low probability because you think that the payoff is here. So eventually, having short sale constraints with the same realization of these random variables and taking a world in which there are no short sale constraints, same random variable realizations, short sale constraints help these more optimistic agents to rule out these low tail states of the world. Then their probability, the conditional probability distribution shifts in this way. And if short sale constraints are sufficiently tight in the market, basically what happens is that you think that these states of the world are very, very unlikely. Your distribution kind of shrinks to the center, and your conditional variance goes down. So yes, so what happens is that those agents with very high signals, they basically never really thought that the payoff of the asset would be low, so they are not really affected. But as we decrease the private signal realization, these agents learn more and more under short sale constraints compared to no short sale constraints. So the conditional variance goes down, and then it would go up. For these agents, eventually it's obvious that the short sale constraint is binding in the market, so they assign like a lower precision to that anyways. Okay, but the important thing is that these short sale constraints help a bunch of kind of optimistic agents to learn more in this sense, in this revelatory price efficiency sense, compared to having no short sale constraints. So once you take this observation into a model with real investments, you can eventually get to scenarios where real investments will increase because, for example, investment would be increasing in the precision of these agents. If short sale constraints decrease increase this precision, real investments increase, and it can lead to higher real efficiency as well. I will have to skip the model. But basically, what this paper tries to highlight is that due to short sale constraints, prices contain less information, but it can provide more information to some agents who have additional private information. So when we talk about price informativeness, we should really separate the FPE and the revelatory price efficiency, whereas the first one goes down for sure because less information is contained in the prices from the signal of informed traders. Some agents who combine it with additional signals can learn more. And I highlight that this can have real effects as well. These agents are more willing to invest in good and profitable projects. The broader implications are that trading frictions change the ability of prices to incorporate and transmit information to decision makers. And so I think it would be interesting to study this a bit more. Thank you.